March 19, 2020. The world is locked down. Hospitals are overflowing. The stock market just had its worst day since 1987. Everyone is panicking about toilet paper and ventilators. But in the basement of 383 Madison Avenue in New York City, something else is happening. J.P. Morgan Chase, the largest bank in America, is buying silver. Not a little bit of silver. Not a hedge position. They are buying more physical silver in a single quarter than some countries mine in a year. And they are doing it while the rest of the world is selling everything they own just to survive. This is not a coincidence. This is not a savvy trade. This is the execution of a plan that took a decade to build, cost them nearly $1 billion in fines, and required them to manipulate the global silver market down to its knees before they could strike. What I'm about to show you is the greatest wealth transfer in commodity history. It has a story that connects a $920 million criminal fine in 2020 to a secret vault in London, holding 1 billion ounces of physical metal. It's a story about how one bank got caught rigging the market, paid the penalty, and then used that exact same rigged market to position themselves as the single largest private holder of silver on planet Earth. The kill switch wasn't designed to stop us. It was designed to stop everyone else while they loaded the truck. Before we go deeper into this rabbit hole, I need you to do something for me. If you're watching this and you want to understand how the game is really played, how the biggest players on Wall Street operate in the shadows while retail investors get crushed, hit that subscribe button right now, smash the bell icon so you don't miss the next investigation. Because I promise you, what we uncover in the next 15 minutes will change how you see every market move for the rest of your life. And drop a comment below telling me where you're watching from and what time it is in your part of the world. I want to see how global this community really is. Now let's get back to the crime scene. To understand what J.P. Morgan did, you need to understand what silver actually is. Most people think it's just jewelry and coins. That's like saying wool is just for lighters. Silver is the most electrically conductive, thermally conductive, and reflective metal on Earth. Every smartphone has it. Every solar panel has it. Every app has it. Every missile system, every 5 tower, every medical device. You cannot build the modern world without silver. And here's the kicker, and like gold, which mostly just sits in vaults, silver gets used up. It gets consumed in electronics and never recycled because it's too expensive to extract from tiny circuits. This creates a structural deficit. The world uses more silver every year than it mines. So where does the shortfall come from? Recycling, government stockpiles, and above-ground inventory. But those sources are finite. Eventually, the math catches up, supply runs out, and price explodes. J.P. Morgan figured this out in 2011. That was the year silver hit $49 per ounce. It was a parabolic run driven by the aftermath of the 2008 financial crisis. People were terrified of banks and buying hard assets. Silver was the poor man's gold. It was accessible, it was scarce, and it was moving. But the rally was too fast. It threatened the paper currency system. So the powers that be crushed it. The COMEX raised margin requirements 5 times in 9 days. They made it 84% more expensive to hold a futures position. Speculators were forced to sell. The price collapsed from $49 to $26 in 2 weeks. It was a massacre. But while everyone else was panicking, J.P. Morgan was watching. They saw the playbook. They saw how easy it was to manipulate the market using paper contracts. And they thought, what if we could do this ourselves? What if we could push the price down using fake selling in the futures market, accumulate physical metal at depressed prices, and then ride the inevitable supply shortage to $100 or $200 per ounce? That's not a trade. That's a heist. Between 2008 and 2016, J.P. Morgan's precious metals trading desk engaged in a scheme called spoofing. Here's how it works. You want to buy silver, but you don't want to pay the current market price of, let's say, $20 per ounce. So you place a massive fake sell order at $19.50. Other traders see this huge sell order and think, oh no, someone knows something, they're dumping silver, I better sell too. The price drops to $19.50. Now you cancel your fake sell order before it executes, and you place a real buy order at $19.50. You just trick the market into giving you a discount. Then you do the same thing in reverse when you want to sell. You place a massive fake buy order to pump the price up, wait for other traders to chase it. Then you cancel your fake order and sell at the inflated price. This is illegal. It's market manipulation. It's fraud. But JP Morgan did it thousands of times. They had traders sitting in New York and London placing spoof orders around the clock. They coordinated their moves. They moved the price up and down like a puppet on strings. And they made hundreds of millions of dollars doing it. The problem is, they got greedy, they got sloppy, the algorithms started detecting the pattern, whistleblowers came forward. The Commodity Futures Trading Commission and the Department of Justice opened an investigation. September 2020, JP Morgan admitted guilt. They agreed to pay $920 million in fines, the largest precious metals market manipulation penalty in history. 3 of their traders were criminally charged. 1 was sentenced to prison. The bank was forced to admit they had engaged in a massive, multi-year scheme to defraud the market. Case closed, right? The bad guys got caught. Justice was served. Not even close. Here's what the headlines didn't tell you. While JP Morgan was spoofing the market and pushing the price of silver down, they were simultaneously buying physical silver, lots of it, in 2011. After the silver crash, the price was in the $20s and $30s. It stayed there for years. JP Morgan's trading desk was spoofing the futures market to keep it suppressed. Meanwhile, their asset management division was buying 1,000-ounce bars and storing them in London vaults. By 2020, independent analysts estimated that JP Morgan had accumulated somewhere between 800 million and 1 billion ounces of physical silver. That is roughly half of all the investment-grade silver in the world. Let me put that in perspective. The entire COMEX vault system, the exchange where silver futures are traded, holds about 300 million ounces. JP Morgan alone holds triple that. The US Mint uses about 15 million ounces per year to make silver eagles. JP Morgan holds 60 years worth of US Mint production. They have enough silver to supply the entire global solar industry for 2 years. They are not a bank anymore. They are a sovereign silver power. And they built this position while rigging the market downward. Do you see the brilliance of the crime? They weren't spoofing to make money on trades. The fines were the cost of doing business. They were spoofing to keep the price low while they cornered the physical market. The $920 million fine was nothing. If silver goes to $100 per ounce, and they hold 1 billion ounces, they will make $60 billion in profit. The fine was 1.5% of the upside. It was the best investment they ever made. If this sounds familiar, it should, because this exact playbook was used before. In 1869, 2 men named Jay Gould and James Fisk attempted to corner the gold market. They were robber barons, railway tycoons, and they had a plan. They started buying physical gold quietly through intermediaries. At the same time, they convinced President Ulysses S. Grant to stop the U.S. Treasury from selling gold, which would reduce supply and drive up the price. As they accumulated, the price of gold started rising. Other investors noticed and started buying. The price went parabolic. Gould and Fisk were making a fortune. But they knew the government would eventually intervene. So before the crash, Gould secretly started selling his position while publicly telling everyone to keep buying. On September 24, 1869, Black Friday, the Treasury dumped $4 million in gold onto the market. The price collapsed. Investors were wiped out. Gould had already sold at the top. He walked away with millions. Fisk was ruined, but Gould became one of the richest men in America. The playbook was simple. Manipulate supply, accumulate in secret, pump the price, sell before the crash. JP Morgan's strategy is the same, but with one key difference. They don't need to sell. Because unlike the 1869 gold corner, the silver supply shortage is real. Gould and Fisk were creating an artificial squeeze. JP Morgan is positioning for an actual physical deficit. The world is going to run out of silver, and when it does, JP Morgan will own half of what's left. They don't need to pump it. Demand will do that for them. They just needed to suppress it long enough to accumulate at cheap prices. Mission accomplished. So why are we talking about this now? Why does this matter in December 2024? Because the kill switch just failed. For years, the paper futures market controlled the price of silver. If the COMEX said silver was worth $25, then silver was worth $25, even if there wasn't enough physical metal to meet demand. But something broke in 2024. The price started rising and the usual suppression tactics stopped working. In May, the COMEX raised margin requirements. It barely made a dent. In August, mysterious large sell orders appeared right before the market close. The price dipped for an hour, then recovered. In November, the same thing. Every time the controllers tried to push the price down, industrial buyers stepped in and absorbed the selling. Tesla, Samsung, First Solar, they don't care about COMEX margin requirements. They need physical metal to build products. They have standing orders. If silver drops below $30, buy 1 million ounces. If it drops below $28, buy 2 million. The industrial bid is a wall of money that the paper market cannot break. And this is the nightmare scenario for the shorts. Because if the paper manipulation stops working, the price discovery moves to the physical market. And in the physical market, there is a massive shortage. Refineries have halted production. Dealers are sold out. The LBMA vault inventories are at historic lows. The price should be $60, $70, maybe $100, but the COMEX says it's $32. This disconnect cannot last. Eventually, miners will stop selling to the COMEX because they can get a better price in Shanghai. Industrial users will bypass the exchange and buy directly from mines. The COMEX will become irrelevant, and when that happens, the price will gap up overnight to reflect the physical reality. JP Morgan knows this. They have been preparing for this moment for a decade. They rigged the market down, paid the fine, accumulated the metal, and now they are sitting on the largest private hoard of silver in history right as the supply shortage goes critical. The kill switch was supposed to stop the price from rising, but it's not designed for a physical shortage. You can't suppress demand with margin hikes when the demand is coming from factories that need the metal to operate. The kill switch failed, and JP Morgan is the only entity positioned to benefit. Here's what happens next. As the price rises, other banks and institutions who are short silver will be forced to cover. A short position means you borrowed silver and sold it, hoping to buy it back cheaper. But if the price goes up instead of down, you lose money. And if there's no physical silver available to buy back, you are trapped. You either default on your obligation or you pay whatever price the market demands. This creates a feedback loop. Shorts covering drives the price higher. Higher prices attract more buyers. More buyers drain the remaining inventory. Less inventory means higher prices. It spirals. JP Morgan will not sell during this phase. Why would they? They already made their money on the way down by spoofing. Now they make money on the way up by holding. They become the lender of last resort. Banks that are short will come to JP Morgan begging for metal to cover their positions. JP Morgan will lease it to them at exorbitant rates. Or they will sell small amounts at $80, $100, $150 per ounce. They control the supply, so they control the price. This is the ultimate power position. They are no longer a participant in the silver market. They are the market. And the regulators will do nothing because JP Morgan already paid their fine. They admitted guilt, they paid the penalty. And they promised to behave. The fact that they used the rigged market to position themselves for a historic windfall is technically legal and ethical, absolutely corrupt, beyond question, but legal. They followed the playbook of every robber baron in history. Cheat, get caught, pay the fine, keep the money. So what does this mean for you? If you are holding physical silver, you are on the same side of the trade as the smartest, most ruthless bank in the world. They spent a decade and nearly $1 billion in fines to get where you are. If you're waiting to buy silver because you think the price will come back down, understand that the people suppressing the price are the same people who have already bought everything they need. They are not trying to keep it low so you can buy cheap. They are trying to keep it low so you stay out while they finish accumulating. The window is closing. Every dip gets bought. Every manipulation attempt fails a little faster than the last one. The market is figuring out that the emperor has no clothes. The paper price is fake, and the physical shortage is real. When the gap between those two realities closes, it will be violent. It will be fast. And it will make the people who position early very, very wealthy. JP Morgan already knows this. The question is, do you? This is not financial advice. This is a history lesson. The same pattern repeats every generation. The insiders rig the game, accumulate the assets, pay a token fine, and walk away with generational wealth. The only difference this time is that you can see it happening in real time. You can position yourself on the right side of the trade. You can buy the same asset that JP Morgan spent 10 years accumulating. Or you can wait for the news to tell you it's safe, by which time the price will be triple what it is today and JP Morgan will be selling to you at the top. The choice is yours. The kill switch failed. The shortage is real. The endgame has begun. If this investigation opened your eyes, share it. The more people who understand how the game is played, the harder it is for them to play it. I'll see you in the next one. Stay sharp.